just want to share some thoughts on the earnings seasons. So different people have different approach to earnings. Just curious, how many of you like during earnings period where company announce their earnings, some of you may worried like your favorite company or your top holdings might drop because the earnings might be bad, or like you just sometimes the market react negatively to it and you're afraid that the company will drop. And then if it drop already, then what to do? Should you like sell some or should you buy more? How many of you got this like perhaps a bit of uncertainty and nervousness when it comes to approaching earnings on? If you have, like, please share. Please just type me in the chat box, right? So no harm. Just want to get a sensing of how many you might have this issue lah. Right. So my approach to, I think that's normal, right? Last time or once upon a time, I used to have this same feeling also. So funny story, right? When I first started back then, I like to, so when I was like learning investing and slowly getting my footing, but still in certain periods, certain situations, I might get uncertain. I like to think like, what will my mentor think? What will my mentor do in this scenario? Or what will Warren Buffett do in this scenario? Will he panic? And so it's like a self-thought process. And then he would think, probably not. So for example, some people might think, hey, what will Wei Ming do in this situation? Will he panic if he saw like Amazon drop or Tesla drop after earnings? So this is something that I used to think about, and I think it helps me lah. So sometimes putting things into perspective. So for me, right, some of you guys know I like to look at numbers. So okay, so let's go to some numbers right now. Okay, let me share my screen. So I think Amazon they just announced earnings, and I think later when the market pre-market they're already down. Maybe I don't know how many points is this. Maybe 7%. Oh yeah, about 7% down. Right, so I'm just using a major example, but of course, whatever I share in this video is definitely applicable to any companies during earnings season or just in general. Right, so when I see things like that, first thing I want to know is go and read out about earnings, what actually happened, and all that. But generally, I would say I do not really pay that much to short-term fluctuation. So I have perhaps a cute way to approach this, and some of you might disagree, but let me just share my thoughts. So I personally don't feel that worried that much, right? Because I'm focused on the long term. So some of you might heard me saying, or other gurus say a lot of times, focus on long term, not the short term. So what does that actually means? So we focus on the long term, right? And if we were to zoom out, right? Amazon share price. How many of you think that Amazon over the long period might actually be a good company to invest in? Right? If you do, right, just type Amazon or type A in the chat box. So I think I shared, 2 days ago or 3 days ago, Amazon is one of the, in my opinion, one of the safest companies. So if you have not watched that video, you can, just check it out. So Amazon is just one of the companies that I think for beginners or people who just want a very safe but consistent 20-30% return, I think is a good way to start, to kickstart. So Amazon, right? So I want to know, like, exactly, people say long term. If I invest in Amazon for the long term, exactly how much my return? You think that's good to know? So I mean, why not, right? So I like to focus on some numbers. So this is a stock calculator, like, so you can use it to backtest. Sometimes I will just play around with figures just to understand the situation a bit better and just to backtest certain stuff, like different duration, different companies, so on and so forth. So you can type in your company name in for here we're using Amazon, and let's say you start with $10,000, right? And over let's say a very long period of 20 years, how well do you think Amazon actually did, right, during this period? Right, so calculate return. All right, so you can see it's 34%. So you can see like from 2001 to 2021, which is right now, I think maybe like 7 days before, because they only use the, I think, like, accurate within the last 7 days. All right, so but it's not too bad. So it gives us a very good time frame over 20 years. So 20 years is more than 30% returns. Not too bad. That means $10,000 if you invest in 2001. 20 years later, your $10,000 will become, $3 million plus. All right. And again, right, a lot of people say, like, but this is a very long-term period. So you can go and backtest for different time frame. What if I only, not this 20 years, but what if I only invest for the last 10 years? Okay, so let me change this. I think it should be about, yeah, also about that. So you can see what does this tell you? So what does it mean? This means that Amazon over a longer term period. So if you look at today, it dropped 7%. But if you look at months, years, quarters, right, like over at least a few years, it should even out to about 30+%. So year on year, it will average. Not exact, so it won't be a straight line. Not like every year 30%, 30%, 30%. But if you average it out, it's about 30%. And the line is return. Right. And a lot of people say, hey, but when, like the Amazon, I look at the chart, most of the returns come towards the end, right? Like towards the end. Like you can see, sometimes when a compounding graph, right, it looks a bit misleading because most of the returns actually come from the last 10 years, right? Like maybe from 2011 to 2021, all right, and not from the first 10 years. But actually, that's not true. If I filter the first 10 years of these 20 years, so from 2001 to 2011, I will get actually more, yeah. So also about 30%, okay, 30 plus 38%. So it's also roughly there. Okay, so actually you realize Amazon has started to slow down. The returns is actually contrary to the chart, the misleading chart when you see the compounding slowing towards the end, you actually make more at the start. But anyway, the point of this is what I'm trying to say is, if you were to zoom out and you adopt a longer term outlook, then actually you don't really care. Well, today is Amazon earning and then drop 7%. Right, to really put things into perspective, and that's the way I like to approach it. Like looking at numbers, looking at facts, putting things into perspective. So I think this calculator is quite useful for some of you to perhaps cement your understanding to a bit more, to anchor your understanding to a more long-term basis. So obviously you can search for any companies you have in mind, right? So I just changing example. If I use Google and so maybe I just change the date to this, to current 2021. Right, it's about 26%. So roughly about that. So you know that if I invest in some of these big tech companies, say for some of you realize the last video I mentioned Amazon, Google, and PayPal, right? So these are some of the 3 companies that I mentioned, and the returns will be about that. Not the best returns, but year on year, you get a very comfortable. We just maybe even to give you a bit of discount, maybe just say 20%. Every year, if your money, your $10,000, just grow 20% year on year. After a period of this period, you end up with $500,000, right? So this is like a longer term outlook. So again, there's nothing, really like rocket science about this, or nothing special no special insights that can come out of it, but it's really just adopting a longer term period, right? And don't worry too much about short-term fluctuation. It's I personally, I will not want to live my life like that, being worrying on the short-term fluctuation, looking at my account every day. For what? Right? So just zoom out. And so in short, how you approach earnings, right, is really how you approach investing in general. If you really have a long-term outlook, that means you really approach investing from a longer-term perspective. Meaning what? Meaning you dollar cost average systematically. You got a plan, like every month on a fixed day, you will just, let's say, buy some Amazon shares or Google shares. Then this is your results, 26% compounded year on year. And some of you might say, but if I dollar cost average, I don't all buy at the start. I dollar cost average, meaning like every month or every few months, I buy some. My returns might be different. So if let's say you start dollar cost averaging, I don't know, towards the last 5 years. So maybe I change this date to 2016 and I calculate. It's also about that. Maybe you started over the last 3 years, then you dollar cost average. All right. So, but you get the idea, right? So this calculator, you can save this link and you can just do a search also, like stock return calculator, it should come out. And then just play around with it, just so that you will get sensing also what you are getting in return for putting in this discipline to, like dollar cost average. If every month I really set aside some money, I just buy, what's my returns are. And there's different ways to go about this also. So some of you who don't know how to choose stocks, because you might think you are the world lousiest investor. The day you invest in Google means the day Google start performing poorly. Cannot, possible not. Maybe if that's the case, right, then don't buy Google. So what you can do, right, is you buy the ETF, buy the whole index, right? Like I mentioned a few ETFs that I personally like, QQQ and all that, right? And then you can invest in it, and then you can check out the returns. It's also about same, right? Oh, okay. So for this stock calculator, they don't have ETF, but never mind. But you guys get the idea. So filter for whatever periods you want. So personally, what is my holding duration? Is it forever? So do we buy and hold forever? And then when do we sell? When do we retire? So this is my own take lah. As long as I'm still able and I may not, I don't need the money, right? I will just put there for it to compound. But as and when let's say I am not working, I don't have any source of income, only relying on my stocks portfolio and a bit of income, then sure. So every year I can withdraw, depending on how much you need. Let's say 100,000 for your living expenses. So every year I will withdraw 100,000 from the account, regardless how much profit I make that year, or if it's like making more profits, I'll withdraw more. Not really. So I will just withdraw a set amount. But that's more of like retirement planning, which is a bit out of the context for this video. But in short, right, any companies that I buy, I'll be looking to hold them with a time frame of like perpetually. That means it won't be forever. It won't be like hold and buy and hold forever, but it's more of like a buy and monitor forever. So if the thing change, if the outlook change, if the company is not as good as it was last time, then of course I will be looking to change it up. All right. So again, and some of you might say, so I have some questions here. One of the questions is, hey, but these companies has already grown so big to today's in today's size. Is there room to grow even further? So obviously you don't expect the highest growth. You don't expect them to grow at 100%, 200% return. But these companies, I would say Amazon, Facebook, Google, PayPal, they're still growing at a good 10, 15, 25% returns. So if you want companies with better returns, then obviously these companies might not fit the bill. You might want to invest in companies like Tesla, Citi Limited, with higher growth companies. But I mean, just using the context of, ignoring the short term and then just focusing on the longer term basis. Of course, if I find, some of you know, I'm more into like that. Let's say we look at Tesla. And because we know last year was a good year, but so let's do a longer term period. Right. So not filtering for last year, but filtering for the last 10 years. Right. 2011 to 2021, invest in Tesla, your annual return will be slightly higher than the 20-30%. You'll get 70% growth. So yeah, so it depends on how much return you are aiming for. So that goes back into, so that will determine the type of companies you have in your portfolio. But regardless of what type of companies, the same thing still hold true, right? You should not, personally, and this is what I do, I don't pay that much attention to, the short-term fluctuation. Today you dropped 10% because of what? Like over this last 10 years, do you think there's a lot of news, a lot of shit that, like the company has to thank you? Sure, for sure, right? Those of you who are in Tesla, you will know. But throughout all this, volatility, bad news, bearish, and anything that you can think of, it's still an annualized return of about 64%, right? So if you were to zoom out, then everything makes a bit more sense, put things into perspective.